A very warm morning to one and all present here. Firstly, a very happy birthday to Professor T. Krishna Kumar. It's being an honor for all of us to be a part of this special occasion. Today, it being the 86th birthday of our respected T. Krishna Kumar sir. So, in his honor, we'll start with the special session now. I would request Professor T. Krishna Kumar to kindly grace the dais. I would invite Professor Saket Sinha Roy on the dais. I would request Dr. Dinabandhu Sethi to come on the dais. I would also request Professor Sushant Malik and Professor Abhishek Kumar to grace the dais. I would request Professor Hippu Salk to kindly come on the dais. And Professor Srijit Mishra to kindly grace the dais. In the honor of the 86th birthday of our beloved T. Krishna Kumar sir, we have presentations from Professor Hippu, Professor Dinabandhu and Professor Srijit Mishra. So starting with the session.
Presentations will be by
So in this special session, there are three presentations. Firstly, from Professor Srijit Mishra and Professor Dinabandhu. Secondly, by Professor Saket Sinha. Thirdly, by Professor Abhishek and Professor Hippu and Professor Sushant Malik are commenting on it. So I would hand over the dais to Professor T. Krishna Kumar sir.
welcome all the delegates and distinguished professors, deans, and my friends, my family members, my old friends. It's a great pleasure to be with all of you. And one of the best things that happens to somebody's birthday when he is among the students is the activity becomes academic rather than other kind of celebration. So I'm very happy for that. And now let me start. And as a chairman, it is my perhaps duty to see that everything is done on time. And the organizers have started 25 minutes late. So that means that much time is cut from each one of the presenters and discussants and so on, if we want to have lunch. And so what my suggestion is that I'm reminded of a situation where one of my friends used to conduct the session as a chairman. What he would do is, he would ask the second speaker to control the time of the first speaker, and third speaker to control that of the second speaker, and so on. And he would walk out of the room and discuss about problems in the corridor. So I would do something like that. So you control the time among yourselves, because I myself, if I speak, I don't want anybody to control my time. Okay. Then one request to all the speakers is, following the suggestion of the Vice Chancellor yesterday, I request each speaker to mention how the topic they are dealing with is related to the theme of the seminar. Okay. Thank you.
So, thank you very much, sir, and a happy birthday once again. I begin with your first thing, how this would be relevant. We are basically trying to quantify empirical financial inclusion. Why should financial inclusion should have a proper method or a proper method of measuring, or why we should critically look at it. See, measurement is very crucial in what we do or what we don't do. Because if we measure things in an inappropriate way, then what conclusions or policy suggestions that come out of it, whether it is for Asia or for the rest of the world, will not be inappropriate. So I think that with that response to Professor B.J. Rao and the question set by the chair, so we begin. So the question I will have, the presentation will have 2-3 parts. The first part is why aggregate measures, given the time, maybe I will avoid using the PPT as much as possible. Why aggregate measures should follow certain kinds of axiomatic way of looking at things. Now here, first part is I will draw the attention to some work that I have done with who is going to comment on our paper. So we will be based on that. That is HIPPO. So while working on the Human Development Index, we thought that what should an aggregate measure be? Can we show the first slide? What should an aggregate measure be? The thing is that when we are talking about indexes like Human Development Index, Financial Inclusion Index, or Freedom Index, or any of those things where you aggregate. So what we are doing, we are taking multiple things and trying to say that give a one number out of it. Now, as economists, we know that this particular problem is very simple to us because we put price on everything and then quantify everything to a monetary value, and then we can say that, okay, that is a single number. But what to do, like in HDI, you have health, you have education, and then how do you measure health? So those were the questions. So one thing, when the Human Development Index people were thinking, they said we standardize each indicator, whatever we thought is health, whatever we thought is education, whatever we thought is standard of living. So what they did is that particular thing, they said that, okay, there is some actual value of an entity, country or individual. So there is an actual value, there will be a minimum value, there is a maximum value. So actual minus minimum, by maximum minus minimum, what will happen is the measuring unit, suppose the measuring unit is life years or rupees. So that will be in the numerator and the denominator, the measuring unit gets cancelled out. So you just get a number, and this number will be between 0 to 1. Now, once you have that number, then you have 3-4 indicators like that. So you can add, you can multiply, you can do many things with it. So that is how this standardized 0-1 units come in. Now you have 3 things or 4 things or 6 things, you can add them. Now when we have 3-4 things of say Human Development Index, and I will now say that's a financial inclusion index. So access to banks, access to branches, or various kinds of things, we take them there. Now, if my measure, final measure is going to help this, then the first thing is that if any of the indicator increases, then the final measure should also increase. If any of the indicator, other things remaining constant. So that is something very simple like monotonicity. And anonymity is that suppose there are two indicators and one indicator has a value of 0.5, the other has 0.3. Now suppose we change the one indicator becomes, the other indicator becomes 0.5, 0.3, then your aggregate measure should give the same. It's something like a symmetry kind of a condition we are putting in. So then normalization is something we are saying that if all the indicators have a particular value, like say 0.3, all the indicators that we have, then your final measure should give that. So this has two conditions. One is it gives that on the line of equality, everyone is equal, everyone has a particular number, your outcome will be same. The other thing is that it gives you the final indicators also lies between 0, 1. That is normalization. And uniformity, I think the Human Development Index started with thinking that, okay, there are three things, and we will add these three things and take a simple average of these things. Now the problem was, if your health was 0.3 and your, say, income was 0.7, then you have an average of 0.5. Now, on the other hand, if you have a country where both income and health have 0.5, 0.5, that is also an average of 0.5. Now, what does this mean is that from the average, the more we deviate from away, we are not penalizing them. So, if you have an uniform or balanced growth or balanced development across dimensions, they should, then the deviation away should be penalized. That we refer to as uniformity. So then shortfall sensitivity is what same thing that, okay, once you have given them 0, 1, 0, 1 numbers, so everyone having 1 will be an ideal kind of a situation. So what we are saying is that, like, suppose it's assuming that this could be a room which is 3-dimensional, and we have an origin and we have a ideal on that corner, top corner. So anything that falls short from that top corner in a 3-dimension thing could be the distance that it is falling short of. So that is the, once it is falling short of that, we are saying that what is the shortfall in each dimension. So your future progress should be such that it should be in proportionate to that shortfall. So that is the shortfall sensitivity. And the sixth axiom that we are proposing is that, or we proposed, is the work that Hippo and I did, is that it should be hiatus sensitivity level. That means at higher level of attainment, the same gap should be considered worse off. Like a simple example is that if illiteracy rate between rural and urban is 40 and 60%, and average, assuming population is equal, average is 50%, and if the average literacy increases to 60, should the 20 percentage point difference between the two also reduce? If you are saying yes, then that is what hiatus sensitivity level means. Now, coming to financial inclusion index, now there are a couple of approaches to the literature talking about financial inclusion index. The linear average I have already told. To address this problem of linear average, HDI now, initially till 1990, they were talking about, sorry, 2010, they were having linear average. And from 2010, they came up with geometric mean. Now, geometric mean fails uniformity. Satisfies uniformity, but it fails shortfall sensitivity and level sensitivity, the last two axioms. Now, financial inclusion index somewhere started with this displaced ideal. Based on my initial thinking, the people, those who worked there, they had a discussion with us in IGIDR, and then they used our method for the initial financial index, which is very similar to what we had proposed. But then what they have done is, now I told you there is a distance from the ideal, there can be a distance from the origin. Now what these people have done is that they have taken the distance from the ideal and then the distance from the origin and then taken an average of that. Now this actually belies logic. It's saying that what is your attainment? My attainment is that my shortfall from the ideal and the distance from the origin, and then I add that and divide it by 2. That cannot be an attainment. Either you say that how much you are falling short, or you say how much you are progressing. Each has its own philosophy and logic. I leave it to the discussant to agree or disagree with us. Now, the problem that I will tell is that if in uniformity, what is happening is I have the displaced ideal is the first one to the left that your figure you are saying. Your iso curves are quarter-centric circles from the origin. If you take from the, on the other hand, if you are measuring from the origin, your iso will be the concentric quarter circles, that is concave to the origin. But if you are taking an average of that, what will happen is what you are seeing in the bottom left side. So what is that showing is that at the top, somewhere it is behaving like the right side, and after the middle, after the line of the top left and bottom right line, it is behaving like the top left line. Now this clearly fails uniformity at a certain space, this particular measure, financial inclusion index, if you do like that. And shortfall sensitivity, also it fails. If you look at the bottom right figure, so you see that suppose I was at 0.25 and 0 and 0.25, and then I start progressing in an ideal path. Suppose I will, the shortfall sensitivity, if I was to move, I will hit the end of the right line. I will not reach the ideal in the optimal path. So it fails in our understanding of shortfall sensitivity. So having explained this in a brief way, what I would now request Dr. Dinabandhu is that we try to give a comparative picture of about 7. Please.
Okay, so what we have done here is we have taken an inverse Euclidean distance function. Okay, and using this method, we have derived the result. So before I get into the result, let me briefly talk about the contribution that we are making. The first one already discussed by the Professor Mishra, that it violates the axiomatic approach. The second thing that is missing in the existing methodology is they take local maxima and minima to measure financial inclusion index. So what happens when we take the local maxima and minima is that the variable, the index data you generate, that is not comparable across cross sections and across time. For example, let's say we have a financial inclusion index of 0.5 for 2012, and let's say 0.9 in 2020. So these two figures are not comparable. Why? The benchmark is different here. The maxima and minima that has been used to calculate the index, they're different. So therefore, to have a comparative analysis, like to have a comparison across time and across cross sections, we need to have a global minima and maxima approach, which we follow here. The inspiration we draw from is the UNDP's index calculated for life expectancy and mean year of schoolings, where they put a threshold as a maximum and a bottom threshold for a minimum. And also we, just to take care of any extreme value being used as a benchmark, we use 94th quantile in entire data as a global maximum in the analysis. So based on this, we have
Just a point. Like if you are familiar with Human Development Index, they say life expectancy maximum will be 85 and minimum will be 25. This is something like that, the logic goes.
on that, we have calculated our results. Can we go to results? Yeah, so here is the result, and we have given the result derived from our index as well as what popular method that is being used, that is Sharma's method. If you look at the ranking and the value also, it quite significant. You know, if you compare the magnitude of the index, first thing we see in the Sharma's method, most of the time we get a higher value. In fact, if I compare with the original paper that Sharma has proposed, most of the values are above 60%, which means that the final inclusion for a least developed country is way better. It means, it says that there is no more scope to expand in terms of financial services. So sometimes this index, the existing index, overstate the true picture of financial inclusion. So if you compare with our index, we have got a value is this, let's say 0.42 or 42% of financial inclusion, vis-a-vis 63 derived from Sharma. It says that yes, there is a scope for a country like Bulgaria to improve, and they're way behind when we compare the global, compared to global average. So based on the ranking, we got that the Bulgaria, Panama, China, Malaysia, they're the top performer in terms of financial inclusion. But when we compare this with the Sharma's index, we don't find these countries being placed in top ranking.
Yeah, there is further analysis. Maybe we will get back as one-to-one discussion outside, or if Q&A allows us the time.
Yeah, so this is a preliminary analysis that we have come up with. So we'll be happy to for questions and answers. Yeah. Thank you.
Hippo is discussing this, right? Hippo? Yeah.
So, so this is, I would like to make maybe 2 or 3 points. So the first to start with, the work basically is getting inspired from a recent work which is actually has taken for an aggregated index calculation a combination of distance from the ideal and distance from the origin. So basically a linear average or an average of both these distances. Now, there need to be some kind of logic for, first of all, coming out this kind of idea, right? Like if I say, like I will take geometric mean, but I will take inverse of geometric mean, means additive inverse of geometric mean, 1 minus geometric mean, and I will take an average of that. It looks odd, right? So, but as you could see, the iso lines that is coming up, so that means you are not inequality conscious when you are developing till the half level of development, and you suddenly start becoming inequality conscious at the later stage of development. If you have looked at those curves, so initially it was not inequality conscious. That means if you are moving in an unequal way, I mean if you are moving more in a particular dimension while neglecting the other dimension, you are getting rewarded, okay, in the first half of the progress. And in the latter half of the progress, you are getting penalized if you are doing the same. Now this is completely, I mean, I'm not referring to this work which is presented, but I'm referring to the work why the original method of having this average of both distance from the origin and distance from the ideal is rather not a very reasonable idea. Okay. Mathematically, one can do anything with these measures, but then it should have, as TKK sir was also mentioning, and Vice Chancellor sir has also mentioned, that it should have some physical or practical implications. Now, the practical implication in this particular case is that suddenly what will happen to any entity for that matter, any organization, any household, or a society, that the society will progress half of the time with rewarding inequality, and then latter half of the time by penalizing inequality. So that doesn't make sense, right? And that is also the point why recent data, for example, with development and inequality relationship with Kuznets curve, which is famously known as Kuznets curve, is being critiqued that, what actually the inverted U that which we got with development and inequality, where the inequality increased first and then the inequality decreased with development, that time period actually all of us might know that Kuznets wrote this paper in mid-50s, and that was the time of post 2 world wars, recession, etc., etc. So he was writing that paper in a very exceptional historical circumstance, right? And that was the reason. In fact, he has written that quite categorically on the last paragraph, the first paragraph of the last section. While concluding the paper, he has explicitly mentioned that this is actually, 95% speculation and 5%, data, in the sense, and that is also tainted with a lot of wishful thinking, that the society will take care of inequality as it progresses. So the point is, society doesn't take care like that. If the society has to be inequity conscious, it has to be inequity conscious from the day one. I mean, I humbly, differ with Professor Sen's that argument where he says society can afford to become inequity conscious later on. Actually, society should afford to be inequity conscious from the day one, because if you are not inequity conscious from the day one, you will not able to probably reverse your policy when you have maintained a policy of or a status quo which is actually promoting inequality. So in that sense, the original the paper on which you both have started working is something, I think, that measure which the author had come out has probably less practical significance. Now with this, I think, because I think you probably showed that doesn't satisfy uniformity, but that satisfy heightened sensitivity level, that doesn't satisfy the shortfall sensitivity, and it was supposed to be so, because when you have measures which are very randomly made, like if I say I will take a measure which is a combination of arithmetic mean and geometric mean, obviously it will satisfy few things and it will not satisfy few things. So it is not a surprise that it satisfies few things and doesn't satisfy few other things. And of course, I think this aspect of how inequity conscious we are from the beginning can be I think greater theoretical or philosophical critique to the earlier measure. With this, I will stop. Thank you.
Will you take one more question and then respond? I missed the weighting of different components in your presentation. So I would like to know whether the weighting was simple average or something else. In that connection, this has some resemblance to Mahalanobis d square distance. So another question is how various components are correlated statistically. If they are correlated, how that correlation is taken into account in the weighting. That is in relation to Mahalanobis distance.
Yeah, thank you, sir. I think Hippo's comments are basically trying to substantiate the point that we are making. When we are aggregating indices, there should be a basis of philosophical basis, or either you are inequity conscious or you are not inequity conscious. And in fact, while you should be inequity conscious from day zero, not one, we should also be, as we progress, our inequity consciousness should increase, and shortfall sensitivity addresses that. So I think these two things, they fail. While we are taking simple averages like what existing methods are already doing, so we are not getting into Mahalanobis distance, and we are not getting into the correlation of the variance covariance at this stage. But maybe future we will also explore that.
Are there any questions from the floor? Yeah.
Thank you for this index. Recently, I was also working with this SLOM index. So I agree with Professor T. Krishna Kumar that why weighting is not there, the latest methodology, this entropy weighted averaging process is there. So without the weight, how the index is justified?
So here the point is, if you bring in, there are various ways that you can weight, but here certain weights are given in a sense that the weights should not vary across space and time. Because again, if that happens, then we go back to the earlier problem of local minima, local maxima. So to make it comparable, if you are doing an analysis even within set of data, then what you are saying perhaps could be fine. But here we are trying to make comparisons across space and over time. So having fixed weights, in whatever method we derive those weights, should be much more appropriate.
Thank you. I now request Professor Saikal Sinha and Professor Sengupta to present.
What's the time? Good afternoon. It's a great honor to be here to speak, felicitating Professor T. Krishna Kumar. When I was a PhD student at CDS Trivandrum, that's that was the first time I could meet Professor Krishna Kumar at ISI Bangalore. He was there then. He had left Hyderabad and he was there then. And the way he encouraged me to do my thesis, and before that I had read his paper almost validating what Mahalanobis had said was true in EPW. There was a huge article that he wrote post-1991 on the efficacies of the Mahalanobis model. Now, having said that, the paper that I'm going to present, which is on the nexus between inflation and exchange rate pass-through, the role of expectations, is actually not my work. I'm only the facilitator, I'm the supervisor. It's the PhD work of my student. I thought my student would come and present, but he is in a difficult job somewhere else, so he could not travel. He made the supervisor to come and get all the galis from everybody for whatever he has done. Anyway, this paper moves to the other extreme of financial exclusion or inclusion, what Srijit and his team presented. And this is on inflation and exchange rate pass-through. Now, as you know, that this is grounded in reality because all the countries in the world over are, even the US, which had very low rates of inflation at one point of time, or all over the years, or many other countries, developed countries, they also reeled under high inflationary pressure in the recent period. Now again, they're back to square one. So inflation thinking, in India, there was a great debate on inflation thinking, and whether the structuralist model holds good, whether the monetary model hold good. That was the debate, and I would love to quote my PhD supervisor, Pulapre Balakrishnan, saying that it's the structuralist model which was holding good when he did the work. But then later on, as time progressed, as the economy became more complex, as the economy opened up, many new factors came in which started explaining inflation, and exchange rate movement is one of that. What is the connect? The connect is that as exchange rate depreciates, the prices, landed prices of imports increase, and as the landed prices of imports increase, the domestic price of the economy increases, and which necessarily is often inflationary. And when imports that import into the Indian economy is more than 80%, more than 50% of your imports are in terms of oil, crude oil, crude petroleum, that is every day used in the economy. The exchange rate changes change the landed price of crude petroleum prices, and that would definitely be inflationary, because crude petroleum is not only consumed in vehicles, but in all sectors of the economy, and that would lead to inflationary pressure. Now here, the link between exchange rate and inflation is through the exchange rate pass-through. How much of the change in exchange rate is actually passed on to import prices and leading to inflation? The framework became, and on exchange rate pass-through to import prices, there are several papers, including one that by Sushant and his colleague Marquez in 2008. That was one of the starting papers on exchange rate pass-through, import price pass-through. And then later on we had worked, then Bhattacharya, Patnaik and Shah, they worked, and there were Patra from the Reserve Bank people had worked on it. Now, the framework, but none of these papers initially had seen the connect between exchange rate pass-through and inflation, because that was not what they had started looking at. This framework of passing of exchange rate, or the link between exchange rate pass-through and inflation, got more complicated as we adopted the inflation targeting framework in the Indian economy in 2016. So in that context, I would like to see what is the extent to which exchange rate pass-through connects to inflation. Before starting to, one thing I would like to remind, most of the studies on exchange rate pass-through that were there, they talked about exchange rate being, there is an incomplete pass-through, because complete pass-through happens only when the market is perfect. So complete pass-through does not happen, there is imperfect pass-through, but none of these studies have talked into the asymmetric movement of the exchange rate, that once it appreciates and then it can depreciate again. So this asymmetric movement of the exchange rate is not being taken into account, and that in our paper we also take into account what is the effect of asymmetricity. Now, there's a large literature, I'm not getting into the literature. Only one thing that I would like to tell you is, there is a debate that it is said that with the adoption of inflation targeting, often inflation has come down. There has been studies saying that, and there has been studies challenging that. Now, and it is said that with inflation targeting being adopted, exchange rate pass-through has also started coming down, and that is also being challenged. The latest challenges are that from Forbes and Forbes et al. By Nasir Ahmed in 2020, and all of them have started challenging that exchange rate pass-through did not necessarily come down with adoption of inflation targeting. And that's where we situate our paper. Let me move to the methodology of how we go about doing this. And let me, before going into the methodology, one thing that I would like to say, that there is a role of expectations in all this. So we are trying to figure out what is the impact of exchange rate pass-through on inflation expectations. Now, before I go to the methodology in detail, we adopt, like many other studies, unlike the earlier structural equation modeling or monetarist modeling, we adopt the new Keynesian Phillips curve approach, which is different from the augmented Phillips curve approach. And in this, we have used many variables, including variables which see the persistence in inflation, that whether lagged inflation, inflation expectations, whether all of them impact on current inflation rate and expected inflation rate, and apart from the host of macroeconomic variables that often determine inflation. So we are using them as control, and we are trying to see asymmetric movement in exchange rate, whether it's leading to exchange rate, determining inflation rate and inflation pass-through. So in the equation, if you see, these are the modified, the estimable equations. The first equation being inflation itself, and the second is the expected inflation. And you would see that real exchange rate, there's a plus, and real exchange rate, there is a minus. The plus one is the appreciation in the real exchange rate that we are putting together, and the minus includes the depreciation. And then we have the cumulative effect also is there in the summation of throughout the period. If there is asymmetricity, then what is the effect? Now, by method, we are using the non-linear autoregressive model, that is NARDL, distributed lag model. And why we use this is because when we go to the this is the unit root test, you would see some variables, the control variables are I0 and some of them are I1. That is one reason, one of the reasons why we go of a nonlinear autodegressive distributed lag model. The other thing is that through this we can, using the NARDL, we actually can capture that impact of asymmetricity in the whole, on inflation. Now, after looking at the unit root test and determining the order of integration, we saw that we did a bound test, as we usually do in case of ARDL, and we found that the F statistic is significant, and that would show that there is a long-run relationship in the variable, that the co-integration exists. This suggests a long relationship exists between inflation expectation and its determinants. Here the dependent variable is being inflation expectations. Now, once we do that, we need to look at the short term. In the short term, I would not read into the results that is already there. We would see that what we got is past inflation expectations have a negative impact, showing an adaptive correction mechanism. The expectations are adaptive and they have corrected for themselves. Past inflation increases lead to higher future inflation expectations. Most importantly, positive exchange rate shocks, that means appreciation, has a stronger negative effect on inflation expectations than negative shocks. Negative shocks also have a negative effect, but a weaker impact as against appreciation effects. And then other factors like oil, GDP, unemployment, fiscal consolidation, and money supply, they impact on inflation expectations. When we do further diagnostic tests, we would see that the R squared is around, the error, first is the error correction term is significant at 1% level. That means the errors, the short-run representation exists and they correct for the long-run equilibrium. Two, the R squared is pretty high. And then we went into a series of tests which shows that there is no autocorrelation and there is no specification bias. However, there is a problem of heteroscedasticity, but that does not, we corrected it for that, and that does not in any way impact on the core results of the paper. Now, let me start concluding. We did further tests. We did some diagnostic tests. We did a Q-sum test which shows the stability of the parameter. A Q-sum squared test at 95% level, it jumps off the band, but at 90% it's within the band. So at 90% it's stable. And if you do a cumulative multiplier, then it shows that 1% currency appreciation leads to lower inflation expectations. 1% currency depreciation raises inflation expectations. So these are the kinds of results, asymmetric results, that we get from exchange rate movements. And the possible route is the exchange rate pass-through is the possible route, even though the pass-through coefficient often, otherwise we have found, and the literature has found, that it is incomplete pass-through. It's incomplete pass-through. So these are the, I am not getting into the discussion, but the results show that ERPT significantly affects inflation expectations in India. Inflation has a strong impact on future inflation expectations. GDP growth, unemployment, oil shock, money supply, fiscal discipline also influence inflation expectation. Robustness test confirms the findings. and expectations serve as a transmission channel, key transmission channel for ERPT inflation targeting. Thank you very much. I would expect comments on the presentation.
Malik will discuss this paper.
Okay, thank you for asking me to discuss this paper. This is a very old debate. So exchange rate pass-through was being debated in the 90s and subsequent decade. But the finding is already well known, well established, not only in the context of high-income countries, but also in developing countries. So there is, as Saikat mentioned, there is a decline in exchange rate pass-through. So it means pass-through of changes in exchange rate to prices of traded goods, exported goods and imported goods. And so when we try to do that, we tend to control for variations in inflation, because inflation will obviously change. Goods prices in that country will change. And well known that when you have currency depreciation, import prices would go up, therefore your domestic prices would go up as well. But what they are trying to do is looking at to what extent it's going to give rise to increase in inflation expectations within the country. So that is quite obvious. I think the point Saikat was making was there has been decline in, because of the inflation targeting, they're talking about a decline in pass-through. I don't think the targeting is really enabling decline in pass-through. It is when we think about decline in pass-through to traded goods prices, it is happening because of the seller's pricing behavior. So seller, in this case, if you are exporting, Indian exporters' pricing behavior would determine to what extent exchange rate changes would be passed on to prices in the destination market. Similarly, when he is thinking in terms of import prices, okay, that which are coming to India, so when you see import prices are not increasing as much as they should have increased when faced with currency depreciation, that is happening because the overseas exporters are adjusting their profit markup. They are not passing it on to buyers in India. Okay, so that decline is a good thing because it reduces prices here, and therefore your inflation expectations will be lower. And that's what he is showing, that there is a negative correlation between real exchange rate and inflation expectations. Okay, so the result is intuitive. It's easy to understand. But I think you'll have to think of some interesting hypotheses that could be useful for or if you want to test, maybe think, because you are using aggregate data, you could think of in a cross-country panel.
We can think in terms of segregating the imports. Actually, import basket, if you take only oil import, if you take only oil imports or capital goods imports separately, because these are the two major imports that are there in the import basket other than consumer goods. So you can disentangle the impact of each of them into inflation expectations.
You can look at also relative prices, because when import prices decline, it's a good thing if you are importing technology, importing raw materials from overseas.
Yes.
Those prices going down, which is a good thing. Cost of production would go down here, and therefore you have a decline in the overall prices here. So maybe, that's an area which you can explore, separating or getting data at a disaggregated level. we did this work until 4 digit, 6 digit
Yeah,
level.
I remember.
So you could think of product level data or a possible firm level. Firms who are importing from overseas, are they really experiencing decline in that import cost? And therefore, they would be offering a price which is lower than what they did before. Right? So you can think of some interesting hypotheses along that line. So I'll stop there. Thank you. It's an interesting idea.
Thank you so much.
Yeah.
It's a very interesting paper. As someone who is not familiar with this, as a person who is not very familiar with the topic, but still curious to know that the exchange rate itself depends on the inflation. And hence there is a interrelationship between exchange rate and interest, inflation and exchange rate. And and both of them depend again on expectations. Yes. So it's a very complicated interrelationship between the two. And so I'm curious whether that is being examined.
Thank you, sir, for this question. As this is a part of a thesis, another chapter actually where we have looked into the factors determining exchange rate and whether inflation differentials between countries determined by varied exchange, US, India exchange rate, the rupee dollar exchange rate and all that, which is amongst all other macroeconomic factors which actually, and one such paper is just about to be published, it's by me and one of my other students, it's just going to come out. An inflation differential between countries, the home country and the foreign country do play an important role in determining the market exchange rate actually. Thank you, sir.
May we have the next paper, please?
So it's really kind of an honor to be here, and especially to present in the honor of a person whom I've always heard about actually from Professor Malik. Very good things. So it's really nice to meet you and present a paper in the honor of your birthday actually. So very happy birthday. And I think you would be generous to me and give me a few more minutes. This is a paper that I have been working with for some time. You guys, most of you have, no, it's fine, I don't need this. Most of you have lived with this. Okay, so most of you have lived with this problem and you have come across this problem several times. And you have always wondered that why this problem occurred in India. And I'm going to give you some reasonable answer for this. So this is a basically twin balance sheet crisis of India of 2010, which led to a significant slowdown in the growth in Indian economy. And there has been a lot of writing about this problem, that why this twin balance sheet crisis occurred, and what were the consequences of this. So basically, if you look at the data that we have in India, this data tells you that non-performing assets in the Indian banking sector increased, just a second. Yeah, non-performing assets increased a lot in the Indian banking sector from 2010 onwards. Look at this. This was kind of a real surge in the non-performing assets in the Indian banking sector. And if you look at the right panel, you see the heterogeneity actually. Most of this increase happened in the public sector banks actually. So private sector banks were somehow immune to this problem. The non-performing assets didn't increase in private sector banks to that extent. Since this problem occurred in public sector banks, there were a lot of hypotheses that came actually without reasonable evidence. So those were hypotheses like that there's a phone banking, corruption, zombie lending, public sector banks are lazy. All kinds of hypotheses were put to explain why public sector banks had disproportionate rise in non-performing asset. Most of these evidences, or most of these arguments, I should say, not evidences, most of these arguments have very little backing in the data. But they became kind of, you can say, the buzzword, and they were always appearing in the newspapers. Phone banking, in fact, even became an election issue actually in this country. So, so it is like kind of something that we all have experienced, and suddenly what happened in this country that public sector bankers were basically seen deceptively, that most of these guys are corrupt. That became the impression, and I know it because my sister is a banker, so, and she works in the public sector banks. So they used to face this, okay, that these guys are corrupt guys doing all sorts of shady lending and making money actually. So that became the norm. And we were not trying to question this, means there were very little attempt to go and dig deeper and see, okay, why this problem occurred and why this problem especially occurred in the public sector banks. Given the fact that public sector banks basically had a significant decline in non-performing assets in 2000. You see there? Public sector banks had seen a significant decline in non-performing assets. So if these guys were corrupt, means something really made them corrupt so quickly actually, because they had a kind of reducing their non-performing assets for almost 10 years, more starting from late 1990s. So this paper, I have already made the issue very clear. This paper is going to give a kind of different angle to this non-performing assets, and this is driven by the business model of the banks. So what we are going to argue is that there is some evidence to suggest that public sector banks and private sector banks are lending differently. Their business models are different. They are lending to different sectors and having different risks. And that explains a lot of this actually, which you have been thinking about as corruption or shady lending or zombie lending. So that has a lot to do with this heterogeneity in non-performing assets than these easy targets that we have always thought about. So I will make a distinction between stock and flow, because NPA are stock. So the data that you see in the kind of RBI website is the stock data. So I'm going to create a flow measure, which is slippage, or you can think of that as a default faced by the banks in each year. So from the existing data set, I will create a flow measure just to make sure that I'm comparing right to right. So I won't deal with the stock measure. So what is the story? This is the broad story that I have, and then I will give you more and more evidence of this. A few more slides after this. So basically, if you look at this, okay, so this is not working. So if you look at this red line is global commodity prices. And if you look at these two measures are basically aggregate flow of non-performing assets that I have created, or we have created. And if you look at these two, you will realize that there is a very strong correlation between these two. Very strong correlation, aggregate, and the turning points are kind of having a very good match actually. So when the commodity prices started declining in 2011, that is when the non-performing assets, two measures that we created, both of them started shooting up. Okay? So we thought, okay, there must be something that this commodity prices did to the banks, and that's why there is a positive relationship, because this is very hard from this positive relationship to argue that, okay, commodity prices were causing non-performing assets. No, you have done econometrics, you know that this aggregate data is of very little use. Means we have a lot of spurious regression issues, endogeneity issues. So what we did, basically we did a lot of data work, and we collected the loans of banks, individual banks going to each sectors. So basically, we know the loans that SBI is giving to steel industry, SBI is giving to chemical industry, SBI is giving to roads. So basically, we have data on sectoral composition of bank loans actually. So I know which bank is lending to which sector and how much, okay? And based on that, I'm going to show you two kinds of result. So the first is what we did, that once we had this sectoral composition of loans, we created groups of banks. Banks having higher commodity exposure, banks having lower commodity exposure, like banks having most of their loan going to steel sector, or very less of their loans going to steel sector. Okay, so that kind of groupings we created, and we started looking at this group-wise behavior of defaults. Okay, so this is our first main result. That is important. So this is basically based on steel exposure, and you might be wondering, okay, why are you considering steel exposure? Oh, steel prices are very volatile, and India is second largest producer of the steel. So our banks do a lot of loans to steel actually, a lot. But not everybody is doing steel loans actually, okay? So that's the heterogeneity. So we created two groups of banks, and we looked at their non-performing assets before steel prices crashed. So that is this blue line. And there was no difference. These guys were having equal defaults actually before the steel prices crashed. But what happened? This is the 2010. Steel prices started crashing in 2011. And once the steel prices crashed, banks having more loans to the steel sector started having higher defaults actually. So you see this orange line? These are banks slightly more steel loans. These red lines, even more steel loans. So the point is that before the price crash, these banks were having similar defaults. But once the price crashed, banks having higher exposure to steel started facing higher defaults. And we did it with several commodities, which is important from India's point of view, and we found a similar relationship. So the point is that, okay, it seems to us that commodity price exposure played a very significant role. And those who have lived in India, they have also kind of learned one important thing, that all these loans were hidden and were unearthed by AQR, Assets Quality Review. The point is, no, it was all there much before AQR. Okay? So this is like kind of excluding AQR. This was all happening before AQR as well. Because you were told all the time that these loans were hidden and somebody unearthed it from nowhere. That's not true. It was always there. It was just building up because the price crash was building up. Okay, and price crash finally culminated in 2016. So this crash kind of started from 2011 and kept going till 2016. I don't have much results to say. I have lots of things to say, but I have already conveyed my main message. This is a 5-year period, actually, in which the price crash was happening. Steel prices went down by 40%. So you think about your top line going down by 40%. Sales price, then what will happen to your borrowings, how much you would be able to repay, no? Okay, so only thing that I would like now say, that this is good, and we also give you a lot of additional evidence that, okay, why this is important, and why we believe it's working. We go at the firm level and see the profitability of firms. And we find that there was a huge decline in profitability of firms in the steel sector and other commodity sectors. So this was a profit channel. The guys got squeezed in profit and they started defaulting on loans. And we also corroborate this with insolvency data that is available now. We have insolvency reform in India. They have put the data. And we also corroborate this with insolvency data. And that data also has 40% defaults in steel sector. And then we also go and dig other sectors related to steel. The final thing that I'm going to talk, and I will just take 2 minutes. So these all evidences are in the paper. If you are interested, you can have a look. So what we do, that we create a commodity price exposure actually. We create a commodity price exposure because I give you examples like steel, non-steel, no? Aluminum, non-aluminum. But then there are 100 commodities, and I need one aggregate measure to find the effect of commodity prices on bank non-performing loans actually, or bank defaults. So what we do that we create a kind of shift-share Bartik kind of instrument where we take the bank's loan going to a particular sector and we multiply it by price of that sector. So no loans going to all the sectors, and WPI, wholesale price index, I also know the prices of all the sectors. So basically I create a bank level price index using the bank loans to sectors and their prices from wholesale price index, and I know the price index bank. So I basically know price index for all the banks, for all the time periods, and then I go and check, okay, what happens to the banks which experience the higher decline in price index? And I find that the banks which had higher decline in price index had more defaults actually. So this is two banks, UCO Bank, which was notorious actually, because it just had a lot of defaults, and HDFC Bank, which was basically the cleanest guy in the town. And you look at their price index here, HDFC had very little commodity exposure. So once the price started going down, HDFC basically price remained on the same path. It didn't change a lot. But look at UCO. What happened to UCO? UCO has almost 20% decline in their price index actually. And that led to basically the surge in non-performing assets. So look, before the price decline, UCO and HDFC had a similar path of their non-performing assets. The big divergence happened when the prices started declining. So we do this with UCO and HDFC. We also do with more banks. So what if I bring more banks and start looking at this? The story goes through. You bring a bank between UCO and HDFC, still you find a similar story. And finally, I will show you one last picture that is about bank behaviors. That is about bank behaviors, that what happened, that most of you who have seen Indian data, this is the last picture, also heard a debate about restructuring and slippage. That banks do restructure loans and then they declare slippage. Now we find that, okay, that is indeed true, because whenever the bank faces these defaults, they do not immediately declare that as defaulted loans. They try to restructure it, and they basically declare them as defaults during a time of 2 years actually. So that is what is available on these results, these two. If you look at slippage and slippage plus restructure, you can see that there is a time lag, and that is related to the bank behavior. I will stop. Thank you.
Thanks, Abhishek. It's a very good paper, and I've enjoyed listening to it. And Sushant, please discuss this.
Yeah, Abhishek did a good job, but he still has a lot of slides which could take like 1 hour presentation to grasp all the results that he has got. But I would make a couple of points. I think we have a limited time. If you look at non-performing assets, they were kept low before 2015. They were low because they were allowed to restructure. There was a corporate debt restructuring mechanism. There was a surface in the beginning. So, you know, there are many initiatives were introduced by RBI to make sure that these bad assets don't increase significantly. So that is why. So when we look at, Abhishek showed in the beginning that non-performing assets were low before. So one could argue that, I'm not talking about the afterward, post-intervention, but before they were low. Suddenly the CDR mechanism, corporate debt restructuring mechanism, which banks were taking advantage of and restructuring all the time through RBI. Okay, so Abhishek has cited one paper of mine, so where we have shown that was indeed effective in reducing, improving stability of banks. So, Now the question is, because this CDR mechanism came to an end in 2015, so one would argue bad assets will go up. Okay? So I completely agree with you. The point you are making is very clear. So there was these banks were exposed to commodity, that sector, or commodity prices, because they are lending to those sectors. So it would be good to, I don't know how you would take care of those, that is my first question. How would you take care of those institutional mechanisms that were in place which enabled keeping bad assets at a lower level? Okay, so one would argue because they stopped that, bad assets went up. That's one. Second, if it is possible to, maybe you showed later on in those impulse responses. So these, your point is that they were lending to these commodity oriented sectors. So therefore, when commodity prices fell, they got exposed, and then those firms could not pay back, and they have so much of bad assets, right? Now, can you show, that there was a decline in lending? Because if that sector is a risky sector, banks would not lend after 2015. Okay, they got to know, and so that commodity prices have declined. So therefore, it's a risky sector to lend to. They would stop lending. So whether you saw that decline in the sector which are exposed to this decline in commodity prices. So those are the 2 points. Yeah.
Thank you. Do I have time? Just 2 minutes I will take. Okay. So I will respond to, thank you for these two interesting points. I think one point we have already covered on the slides, but I could not show due to paucity of time. Yes, there was sudden jump in non-performing assets, but if you look at the data carefully, the buildup was there, and the heterogeneity was there before the kind of this CDR went off and AQR came in, actually. So the heterogeneity was there. So even if you just look at 2014, you will still see that these two groups started behaving differently. But the small difference just got widened after the CDR went off and AQY came. And that is also because they were restructuring and doing everything and not declaring, utilizing those methods. But the kind of differences arose in 2011 itself, the moment, although small, and got widening up. The second is, okay, so I don't think that those endogenities are kind of driving results to a large extent. But about the scaling effect, yes, indeed it is true. Banks basically lent for a while, possibly to save it, and it's zombie lending they were doing for a while, just to save that these will not default. But once it became imminent that these guys will default, they stopped lending. And there is a scaling effect, actually, I'm telling you. We are doing this work still. There is a scaling effect. So once you burn your hand, you do not go to that sector for years. This is what happened to ICICI Bank when it was in kind of development bank in 90s. It burnt its hand, and it's not lending anymore. It became a consumer bank. Now, SBI also has become a consumer bank. I don't know how many of you know or not. SBI also has become a consumer bank. SBI is not lending, actually, to industries, because it has burnt its hand. UCO Bank, Canara Bank, all has become consumer bank. So there is a scaling effect that is happening, and that is also kind of creating problems for our investment. That is something we know. I have some evidence that I can show you. There is a follow-up work where we saw a scaling effect for the banks. It's a just long-run effect. Okay, so those guys who got burnt lot, they are most scared to lend, and they are trying to diversify. Now, finally, one line about the size of the effect. The point is that these commodity prices are consequential, as Professor Malik said, because if you know from the US, there was 20% decline in housing prices, and you know what happened to the US. The banks giving housing. No, that is entire global crisis. 20% decline in housing prices, and see what happened. Here I'm talking about 40% decline in steel prices. So It's like obvious that it will do something actually. Only how much is the question. And we have some evidence to suggest that 30% of these NPAs that you saw in public sector banks came because of this commodity exposure. 30%.
Thank you, Abhishek. Thank you. So we are running out of time. So although I don't expect any answer, I have a question. You have examined the data on the basis of commodity exposure and banks, and I would like to know how it would turn out if you go by the size of the loans, size distribution of the loans, and again size distribution again by commodities and by banks. That may be revealing, but some more information.
Thank you.
Thank you. Session, and thank everybody for the participation. I hand over the mic to Sriju.
We are.
Yeah, okay. This is my sister-in-law.
That's what I wanted to tell you, is our very affectionate brother-in-law. Whole family is very fond of him, and that's why we have really, my friend and I made an effort all the way from Hyderabad, Sainikpuri, to come and be with him. Thank you all.
Yeah, okay. So now we will be requesting our his colleagues, teachers and friends who may speak a few words about your collaboration or anything. Professor Narasimha Reddy Garu. We can, sir, you may please be seated there. Okay.
First, let me wish you
Thank
Happy
you.
New Year. Many
Thank
happy
you.
returns.
Thank you, thank you. Have some pictures taken, please. Yeah.
You know, one of the rare things you see here is, academically speaking, both may be teachers, but both may be in economics. But you know, we had a very fascinating time when he was there for 4 years. I am supposed to be mostly political economy person. He's supposed to be very hard, kind of a quantitative person. I don't say that they don't go together. But only thing is that then when political economy comes, we don't wait for the measurement. We want somebody else to do it. We have lots of questions. And therefore, I think when we raise the questions like provocative questions, that you have measurement without theory. Of course, we have theory without much measurement. This perhaps helped a great deal of coordination. It requires a great deal of open-mindedness. One of the lessons that I am trying to put before you as youngsters and old people also, in spite of our kind of work, which perhaps always comes into kind of a dialogue rather than that of a agreeing with each other, we have an open mind and appreciate each other's work. That's where academic work can progress. I'm very happy to come back and stay with you.
Yeah,
Wish you all the best.
See, I also want to, I said this yesterday in front of the Vice Chancellor. When I was here for 4 years, I was a quantitative economist with statistics and mathematics, and I used to learn from my students. He was a very popular teacher. So I used to ask my students, what makes him so popular? Then I knew that what makes him popular is the subject matter. Okay. then I took interest in the subject of political economy. So after I left from here, I started. In fact, Professor Sushant Malik will remember in 91 when there was a devaluation, I said, as an econometrician, I would like to know what econometric model gave that 19%. And there was no such model at all. Okay. So that is when I went into the political economy and wrote an article in EPW in 93. That was the first article in EPW. And that owes to my association with DNR.
Thank you, sir. We would like to request Mrs. Nirmala Garu, if you would like to say some few words. No, we have been here for.
I'm sort of, I'm really speechless looking at all the love and affection he's getting from his students and colleagues and the university from way back to now. Every time we go to any university, he is always followed by all his students and appreciating, and I'm understanding why he is so much attached to the subject and spends every day, he stays up to 1 o'clock even now studying. Now I know why it is, and all your papers, all your suggestions, and he reads everything, and thank you for your association with him, which made his life very happy, and nice meeting you all.
Thank you so much, madam. Professor Omkarnath. Oh, yes. Professor Prakash Rao Garu.
My name is Prakash Rao. We have been friends since 65 years. We were both contemporaries at Andhra University when he was doing BSc Honours Mathematical Physics and I was doing BA Honours Mathematics. Then we were contemporaries at Indian Statistical Institute when I was doing my MSTAT program and he was also doing his second year of the certificate course. And later on, there are 4 of us, you can call them, I don't want to call it Dushta Chatushtayam, but 4 quarrels, all of us together, we still have meet once in 2 years at least. The 3 of them, including Professor Krishna Kumar, are in the United States, I am in India, but we always have a Zoom meeting where we talk to each other. We continue our friendship. I am a theoretical statistician, he is an econometrician and economist. He made me economist for a short time. I will talk about it in another time. But it has been a great pleasure to have his friendship. In fact, I can say a small anecdote. He went to United States in 1962, and I went in 63. Probably in those days, all of you know, no foreign exchange was available. We were given just $8 to go to United States and do our PhDs. So I had just $8, so the first month was very difficult to survive. So I approached my friend. He gave me a check for $50, and that's how I survived the first month. And next month, of course, we have my teaching assistantship, which was helpful. But then, he was doing his PhD in economics in Iowa State University. I was doing at Michigan State University. And then that friendship continued till today. So I'm very happy to be associated with this function. Thank you.
Thank you so much, sir.
Yeah, that friendship you talked about was, we also tagged each other in which. So I was in Iowa State and he was in Michigan State. They are not very far. So we used to visit each other. And then I went to Berkeley, and then he also went to Berkeley. And from Berkeley, I went to IIT Kanpur. He also went to IIT Kanpur. Like that, it is continuing. And in addition to that, our personal relationship, we have been meeting each other every year. I'm really proud of him. In fact, when he was the director of ISI, I moved to ISI as a professor, and he played a very important role in my joining ISI. Okay, and I retired from ISI. Okay, thank you.
Thank you, sir. Just Professor Manohar Rao Garu. Sir.
First of all, happy birthday to you, sir.
Thank you, Manohar.
And it's so nice that, Srijit and Sushant have invited me personally to join this occasion so that, on this great occasion, I have been sharing my ideas with you at this moment. Professor Krishna Kumar joined just before we joined University of Hyderabad. As Professor DNR said, I also sail in a different boat than Professor Krishna Kumar, but then he was a great inspiration for all of us. Particularly in health economics, I have learned a great deal from him. And after he went to ISI Bangalore, I started initiating health economics in this university. And later on, of course, I picked up development economics also from DNR, and I continued with it. So political economy of development, development economics, and health, these three things continued. And today, I'm so happy that, I could be with so many of my old students who are professors and colleagues elsewhere. And this occasion makes me very, very happy. And I hope this will continue. That is the beauty of this profession, teaching. So the academic interaction that makes us so, active and rejuvenating. So since last 2 years, I was not able to move so, refreshingly because of my health condition and because of various other things, my mobility and all. But otherwise, I thank you all, and I thank you, sir, that I got this occasion to meet you. And I particularly thank Srijit and Sushant for inviting me to participate in this occasion. Thanks to everybody. I could meet all of you here. Thank you.
Thank you, sir, very much.
Now, opportunity for me to thank Srijit.
Professor Naresh Sharma.
Professor Krishna Kumar, first of all, let me wish you many, many more very fulfilling years. And with the satisfaction of having lived a great life and continue to do so. With health, happiness, as well as all that you are going to contribute in the years to come. I have 3 institutional links with Professor Krishna Kumar. In spite of that, we have never crossed roads anywhere except occasionally. We share alma mater, that Indian Statistical Institute. Although he was in the sort of mother center, father center in Kolkata, BT Road. I was in a baby center, Shaheed Jeet Singh Sanskrit Marg, the Delhi center. Subsequently, I also discovered that IIT Kanpur is one common, but there our roles are different. So I don't know whether I can call him generalized teacher, as you're talking about, because he was teacher there much, much before I joined. So I joined there in '74, so that was many, many years after you had come and left IIT Kanpur. Then, of course, University of Hyderabad. We are again our roles are same. We are both ex-teachers now. So when you come, I already become ex-teacher also here. Apart from that, today, thanks to BLSP, we used to call him BLSP there also. You are a generalized teacher in ISI. So I have also discovered that I don't know whether you still have that kind of link with physics. That was my, people used to say that my first love. So I came to know mathematical physics, I came to know today, which has given me a lot of friends actually over time.
Yeah, actually, to answer that question, Sushant introduced me to one of his friends, Amit Kumar Chattopadhyaya, and he and I have written a few papers on economic physics. So we apply dynamic models from physics to economics. So
Great.
Thank you.
In fact, talking about that, one person who was totally unrelated in his profession, like we are probably not that because economic physics has come, that term. A former director of NRCS, National Research Center for Sorghum in Hyderabad. We met somewhere in some connection, and then we became friends because he still continued to have love for physics, and he gave me some books of Stephen Hawking and all that. So somehow that fascinated, I think it fascinates a lot of young people. Some people don't grow old in that. So that is the thing.
Actually, so fascinating that I married a physicist, nuclear physicist, my wife.
Now, Professor Krishna Kumar also, I have a special fondness because he was instrumental for me to give my first talk here in University of Hyderabad. And I think it happened the day you were having some farewell dinner, which was organized in current VC's laws, which used to be used as guest house at that time. I don't know whether Professor DNR was head of the department that time or not, but he must have been somewhere close to it, if not already head of the department. He in fact said that, why don't you give a talk? And then I learned when I came here that he is leaving soon. I came here, I did not know at that time I will be coming here, although I knew that I will be in Hyderabad. And after his 4 years, I have spent 23 years after I joined here. And I must share that I have followed in some way in your footsteps in teaching general equilibrium theory, which nobody wanted to teach in the department. So since I joined, from next year onwards, I've been teaching till it was removed from the core of the general equilibrium theory. It was removed from the core of the program. Till that time, I taught from the moment I joined. And I found some of your, the syllabus, I think you had from Arrow's program, some sheets were there, which also I found from office, and it was wonderful to associate there. So at, you can say at the spiritual level or soul level, there are some link, although physically we never interacted on these things. And last memory is, of course, that you came after many years and gave a talk, I think in poverty, some 5-6 years ago or something like that. It was a wonderful talk. It was a different approach. So thank you so much. And hopefully we'll have a more live association in years to come. I am more free because I am not so professionally engaged. I want to do other things. So thank you very much.
Thank you, Naren.
May I request anybody else from the... Yes. Please, Doctor.
Mine will be a conclusion.
No, we will have others. Please.
No, mine is not exactly professional.
No, please.
So, yeah, just wanted to say that he's my dear uncle, my mama, my youngest aunt's husband. And I remember way back in the when was it when you were a professor here? I was hardly a child and I came here. And my aunt used to say, welcome to Dosa land. She used to call this Dosa land, if you remember. Flat rocks everywhere. And I used to be I was fascinated, what a jungle and what a place. Never did I imagine that more than 40 plus 45 years from now, from then, I would be actually in the university working here as, as the chief medical officer of the University of Hyderabad. And I was just remembering those, recollecting those days and all. and wanted to just say, Mama, wish you a very, very happy birthday, and that you will be coming again and again to visit us in the university, and that, you know, you'll have many more wonderful birthdays ahead. And yeah.
I think if people are will be going for lunch, so I'll try to I'll be very brief. We have a long association spanning over I would say nearly 35 years, nearly, not exactly. And 1990, Professor Krishna Kumar taught us economics of growth and development. That's how we got to know him. And subsequently, my association with him started. I don't want to go into a lot of details that it would take probably half an hour to detail. But I must say that it has been a great occasion here to celebrate his 86th birthday. 86th birthday, but we did another conference, Srijit and myself, we did a conference on his 7th birthday. That, we did that in Bangalore. I am back, he spent 17 years in that. So it was, we did a conference on quantitative approaches to public policy. It's an area where he has contributed a lot. After he came back to India, he spent over 15 years in the US, and he came back to India to help young scholars in India. And this is not many people do. See, I've been there in the UK, but I keep coming just to, you know, to have that association with the scholars here. And I'm truly, both Srijit and we are pleased that we could organize this conference on his 86th birthday, and I hope we will be able to do again. So I have already invited him to come to, we are doing a conference in IRMA. IRMA, actually, the director of IRMA is here, Umakant. Yeah, so we would be, so I have already extended the invitation, but we will do it formally. And so it would be good to have him there, and we could also similar special session, you know, to honor him. And so just to conclude, he has been a great mentor to many of us, not just to Srijit and me, many students, and also he has been inspiring to many young scholars here for last 2-3 days, and participating in every session and also chairing and so on. So I personally have benefited a lot. I didn't know what is research. So first time I learned how to do research. I did a master's degree here, and 91 I started to work with him, and he offered me a job to work with him at ISEC Bangalore. So that's when I started learning how to do research, and that's an important contribution for him in my academic career. And of course, I am also, in the same way, I'm helping younger generations, younger people who, you know, both in the UK and elsewhere, to the extent I can. So thank you very much, and once again, happy birthday. Yeah.
Thank you, Sushant. Vishwanathan, you wanted to? For everybody, you must be hearing the other day when we had the game theory lecture, I mentioned that I did some mischief, and then I took help of some of my classmates to give those rows. One row, one diagonal will have larger numbers and another diagonal will have smaller numbers. He was one of among them who helped me in that mischief. Professor Vishwanathan.
Thank you. So the moment Srijit invited me to this event, and again, he told that Professor TK is coming, I could not actually think otherwise to just to join. So thank you for inviting me. I'm also grateful to Professor Krishna Kumar sir, because that was during 1992. We were actually very fortunate to attend to his classes on econometrics and also several debates on poverty. Those things were really amazing. The fundamental problems of poverty and measurements of poverty, those things have been quite revealing in terms of even though I have not worked on those things, but then still those learnings are very new in my mind. Thank you, sir. I wish you best, and again wish you all the best. Thank you. Happy birthday, sir. As a token of appreciation, great gratitude, I wanted to share a small piece memento from the university. I work with the Amrita University, Amrita School of Business, Amritapuri, Kollam, Kerala. Thank you.
Anybody else wants to say something? Yes, Umakant.
Happy birthday, first. Dear sir, of course, I'm not as lucky and fortunate as Susanta, Srijit, or Biswanath. I think the year when I joined this institute, he has already moved to Isaac. But we directly or indirectly got a lot of inspiration from my seniors and others. Even for the 70th birthday, where they got the opportunity to meet you, but there also I could not get a chance to meet you because you couldn't come because of... fortunately, last year in 2024, I got a mail from him that he's visiting to Baroda and then wanted to come to Anand. I said, what an opportunity for me, and I think you made it. And that was the first time I'm in person, though I know him, though I'm a student of this place. And wherever we are now, it's because of the institute and people like Diener sir and you and Kamiya. So those are the people who saved us, and a lot of credit goes to this institute. So let me take this opportunity to invite you in person to IRMA. When they wanted to organize, I told them I'm not sure, because I wanted to hold it in IIT Madras, and I left IIT Madras. So then when they wanted to give me the second offer, they said, please don't count me, because I don't know how many days I'm going to be there in IRMA. But today I think I'm going to be there in IRMA, so to take care of you. So at least till that point I will be there. So this is an invitation, personal invitation to you. And sir, we owe a lot to you, not just as a teacher, but otherwise also as a person and researcher. Many of us got inspiration and motivation from you and from your research and studies. And wish a very happy birthday today. And many more years, we wish we continue doing this the way we are doing today. Thank you very much.
Thank you. Thank you very much.
I think Mr. Umakant just mentioned, so you must be hearing about Tribhuvan Sahakari University is coming up, and he has been the brain behind that working. So that's why I to say. So congratulations, Umakant. So yes, and maybe Sushant, if you come, three of us from the same batch when she's speaking, so we'll have a photograph taken.
Yeah, we're same batch.
It's a great privilege and honor to stand before you and speak words about our exceptional professor, Krishna Kumar Garu, who has really transformed the landscape of the academics. I think the words are very scarce to express his contributions. As a student of economics, my experience I just would like to share here today. The very first day when I was having his lecture, he took the lecture and also took the attendance, and then he called me to his room. I don't know whether sir remembers that or not, but when I went to his room and he said that I think you have come from a very reputed family, the scholarly family, the Nori. The name Nori, you have many eminent scholars in your family. At least do you know that, he said. Then I said, sir, some of them I know my great-grandfather wrote some, Vedas in Telugu, and then they also got published. but I don't know any of them. Probably my father might be knowing. Then he said, he just kept his hand on my head and said, in future, you have chosen this profession. You landed in economics, and so therefore you have to come out with excellence, and you have to be the next generation who has to come out with such kind of achievements in your life, he said. I don't know whether I lived up to his expectations and to the expectations of my family, but somehow I feel that because of this rooted knowledge given by the eminent professors of the University of Hyderabad, I can very, very clearly say that we are making some say in our institutions. Exclusively when I'm teaching in the MBA institution, economics has not been considered as the greatest subject. It has been as something like a secondary subject, but I always become very emotional and say that no, economics is a very good subject. I was taught by very eminent professors, and I always used to get emotional. So you really, and one more thing I want to share with all of you, is teaching all the time the three-dimensional graphs and the data. So we were all very much sometimes used to see at him and then used to try to understand. But slowly he used to try to take the students to the real world challenges. He always used to give the scope for the students to critically analyze, take the economic principles and apply to the real world challenges. That's the greatness of this professor here. So I'm really very fortunate to be with of your students here. Really, thank you so much. And I think the future generations will definitely take your words, your wisdom, and so you're inspired the future generations forever. I wish you a very, very long life, many inhabitants of the day. So please bless me, sir. I want to bless you, sir.
Thank you very much. So I think we will now the students will take over. They will be felicitating Professor Kumar and some of our teachers here, and over to you. And I'll just final moment. I think when Professor Narasimha Reddy Garu came and he said that measurement and political economy, but you can see me, I think a combination of both.
As all of you know, this is my 86th birthday, but this is the best birthday I ever had. Because as you have seen, the academic life has been very dear to me, and nothing is more enlightening than this kind of a celebration. And then this morning I was greeted. The moment I woke up, the first message I got was from Sushant Malik. And his wish was that apart from other things, one thing that caught my immediate eye was wish you many more years of academic curiosity. So that is something very dear. Thank you.
Thank you so much, sir. Now I would request our volunteers to kindly felicitate the dignitaries. Firstly, Professor T. Krishna Kumar. Professor Narasimha Reddy. Professor Nirmala Rao.
Professor B.R. Prakash Rao, B.L. Prakash Rao.
नहीं है हाँ ये है Professor J. Manohar Rao. Professor Naresh Kumar Sharma. Thank you all. In honor of Professor T. Krishna Kumar, we'll be sharing a video clip with all.
It's a pleasure to talk about Professor T. Krishna Kumar. My association with Professor Krishna Kumar goes back to about 35 years ago in 1989-90 when I had joined the Department of Economics, University of Hyderabad as a student. He taught us growth theory then, but subsequently around 92 at the Institute for Social and Economic Change, where I was there for a short period of time as a student, he was teaching game theory and quantitative tools and techniques, and it is there where my academic interaction started to take shape. And it so happens that his 86th birthday is on the 8th of February 2025, and in the International Conference on Enabling Sustained Growth in Emerging Asia, we will be celebrating his birthday with a special session by reading papers and by reminiscences from his colleagues and former colleagues and students. So we wish well a long life, and that he continues to inspire generations of students and academia.
Hello everybody, I am Dr. Krishna Kumar's brother-in-law. Dr. Krishna Kumar got married to my sister in 1966 at Nagpur, from where I also come. Whenever he used to come to Nagpur and I happened to be there, both of us have lived our life in two different continents. He spent most of his lifetime in America, whereas I have spent most of my time in India. But whenever Krishna Kumar used to come to Nagpur, he had a wish to visit these two places. One was Gondwana Club, where his marriage reception was held. This is a nice little club on a hillock. It has a huge big green lawn surrounded by massive trees. So that is one place he used to like to visit. And second place was Sitabardi, the busy street in Nagpur where almost everything is sold. It reminds me of Sultanbar of Hyderabad. So these are the two places I used to take him whenever he used to come there. He wouldn't drive, but I used to drive, and in those days we had ambassador. So we'd go around the city with him for these two places. Most of my interaction with Dr. Krishna Kumar has been either on WhatsApp or on phone. His conclusions are based on his education, on his knowledge of entire life, on economy and things like that. Whereas mine is based on the fact that as a doctor, I have held more than 20 camps. Most of the Adivasis areas were covered, and I have operated nearly in hundreds of cases, and I find that over 2 decades, I did not find any change in life of these poor people. So that's why both of we feel that economically successive governments have ignored the poorest of poor. The second thing where our ideas meet was that I am and he, both of us are against religion being mixed in politics. We feel that religion should be left out of politics to be a condition to which either Dr. Krishna Kumar nor I subscribe.
It's my pleasure to recall about Professor K. Krishna Kumar, who had been one of the best teachers who have taught at Department of Economics. His lectures were like a song. Even the most difficult mathematical concepts, he could actually explain with that much amount of clarity as if he's peeling a banana. And I remember him as extremely loved, and everybody enjoyed his lectures immensely.
Thank you for inviting me to speak on the day of felicitation for Professor T. Krishna Kumar for his 86th birthday. I'm glad to be part of this group for this function. Professor Krishna Kumar is known to me for the last 65 years. We were both students at Andhra University. He was doing his Bachelor's of Honors degree in mathematical physics, and I was doing Bachelor's of Honors degree in mathematics. Even though we were both students at Andhra University during those days, we get to know more of each other after we moved to Indian Statistical Institute. And he was a student from 1959 to 61. I was a student there from 1960 to 62. So we are maintaining our friendship for the last 65 years. And we do meet occasionally when I go to United States. Professor Krishna Kumar is very special for several reasons. One is, even though his name is Krishna Kumar, I used to call him Chaturvedi. During those years, Dr. C.M. Trivedi, Chandulal Madhavalal Trivedi, he was the governor of Andhra Pradesh. But Trivedi means you learn from three Vedas. So I used to call Krishna Kumar Chaturvedi. The reason is his basic training in Andhra University was in mathematics and then physics. Then he moved to statistics at Indian Statistical Institute and then specialized in economics. So there are 4 subjects on which he did specialization, and he has contributed extensively to economics. So I think Chaturvedi is apt for his scholarly advances. Krishna Kumar invited me to write an article along with him on characterization problems, and this paper was published in honor of late Professor C.R. Rao in the Journal of Quantitative Economics. And this paper is jointly by both of us. And he has also invited me to be a editor for the special issue of Journal of Quantitative Economics. So Professor Krishna Kumar has been associated with the Indian Statistical Institute, Bangalore for some time. He was in University of Hyderabad, and later on he moved back to US, and our association has been very long. And I would like to thank the organizers for inviting me to be a part of this function. Thank you.
As we are here today for this highly acclaimed conference, we take a moment to celebrate a truly special occasion, the 86th birthday of Professor T. Krishna Kumar, whose contribution and wisdom continue to inspire us all. To commemorate this occasion, I'm privileged to invite Professor Krishna Kumar to join us for a cake cutting ceremony. May I also request dignitaries to accompany us on stage as we share this celebratory moment. this joyous day. We extend our heartfelt wishes for continued good health and happiness. It is an honor to recognize someone whose dedication and leadership have felt an indelible mark on our field. Delegates, lunch is being served in the cafeteria down. We'll join for the technical session after lunch. Please have the cake and then you can cook.